Okay, so here we go. This is what I think Procter and Gamble should be selling for. It's based on two different valuation methodologies. So first off, we have a discounted cash flow. Second, we have an EV to EBITDA valuation. So the question is, what do I think this company should be selling for? Keep watching to find out. Thanks everyone so much for watching. I do want to remind you I'm not a financial advisor. This is not financial advice. This is just my opinion. And let's face it, I am not right 100% of the time. So please do your own due diligence. All right, let's go ahead and get started. We're going to start with dividends. And also just want to remind you, like, subscribe, do all that great stuff. And also have some affiliate links below if you want to check out any of those things that support the channel. Please take a look down there, browse, see what I got down there. First off, Dividend Metrics. So what is amazing about this company, they have increased their dividend 66 years in a row. So basically, this is a dividend king. A dividend king is actually better than a dividend aristocrat. A dividend aristocrat has increased their dividend 25 years consecutively. This is even better, 66 years. I mean, this company is likely not going to decrease its dividend anytime soon. So if you're into dividend investing, this company is probably a good thing to be on your radar. We have a dividend yield of 2.53%. The dividend growth over the past 3 years has been 4.91%. Now, if I take this and I compare it to the free cash flow of the company, I can see that there's 53% of the free cash flow is going towards this dividend. That's okay. The other part, though, is I don't love, and this is the share buybacks. So if you add in the share buybacks along with the dividends, it's a lot more than the actual cash flow of the company. The free cash flow of the company. So I don't like that. I want it to be, of course, more sustainable sounding. So when I do this valuation, I basically assume that this company is going to not be buying back so many shares because, as you can see, they're spending a lot of money on dividends and share buybacks, and how much can they really do? All right, so we have our first valuation methodology here. So remember, we're doing two. We're going to do a discounted cash flow and an EV to EBITDA valuation. This is the EV to EBITDA valuation. So what I have here is a target price for, let's call it this year, a year from now, is $125 per share. That's what I think the company's fair value is right now. Now, that's actually a negative 13.21% return. So I actually don't love the company right now given this return. This would equate to $158 in 2026, and that actually gives me a 1.85% rate of return. So don't really love the stock right now from a rate of return perspective. Now, if you're a dividend investor and you want to see a good dividend yield, get some dividends and stuff, maybe have something that's more stable, maybe this stock is more for you. It's probably not, in my opinion, going to grow a lot more than, let's say, the overall stock market. Do remember that this is the first valuation methodology. I'm going to go through another one in a few, and we'll see if that one's even better or worse. But let me just show you real quick what I have here. So the first step I do is I find the shares outstanding. So I don't have this buying back shares. Like I said before, I don't think it's necessarily that sustainable. We go to the EBITDA growth. So we have the forecast, what I forecast, and I forecasted 6% going forward. The median and the average growth rate of the EBITDA is actually about 6%. So I think I'm happy with doing that. Looking at backward numbers, next up we have the historical EV to EBITDA. That has been 18.44 on the average, and then the median has been 16.41. I gave it about a 16, so I'm going a lower than those two, a little more conservative, and that gives me a target price of $125. Like I said, negative 13.21%, and then $158 growing to in 2026, 1.8% rate of return annually over that time period. Now remember, this is a pivot table, so if you are more bearish on the stock, this would be what I would look at, and if I'm more bullish and I want a higher multiple, an 18 multiple, then I'm going to go here and I'm going to say, yeah, it's probably fair valued, a little bit under fair value right now, over fair value right now. So that's the first one. Let's go over the next thing, which is what I call my Cat 5 score. So this is a little personal thing I made up. I created this score, and it's based on things I like to see. What I wanted to do when I created this is I wanted to look at different metrics that I care about versus the actual industry that this company operates. I don't like necessarily just comparing it to one or two companies. I like to see what's going on in the industry. So what I do is I have these different scores. So first off, I have the industry-based valuation. The Cat 5 score for this one is a 10%. I like to see these scores at 70% or higher. So an evaluation standpoint, based on the industry it operates, don't love it. Based on the industry profitability, it's actually a profitable company, comparatively speaking, to its industry. That's good. The industry-based growth is close. It's getting there. It's not too bad, but it's a 60, so it's a little under that 70 that I like to see. Liquidity score is actually 100%, so it's good. And then there's a Rolex score. I'll explain this in a second, but this is also 70%, which is also fine. So I got a Cat 5 score of 50 for this company. Now, a little bit less than I like to see. 70 is my preferred score. So quickly, let me just show you what I got. So what I do with these is I take, for example, the first is the industry-based valuation. I take the PE ratio of different companies in the industry that operates. This is its PE ratio. This is the decile that it is in. And so you want it to be in a like 1, 2, 3, or 4 decile, meaning that it's cheaper than some of the companies in the industry. And this is at a 2. So, or I'm sorry, this is at a fifth decile. And because it's at 5th decile, it gets a 2-point score for this. And so that's what I do for all these. So all these other things, forward PE, price sales, price free cash flow, they're all higher than other companies inside the industry. So I don't like that. It makes me think that this company is a bit expensive based on valuation. Now you come down here, you have the other things. You have the industry-based profitability. Take a look here. We have gross margin, net margin. We also have the industry-based growth. So here we have revenue, earnings per share, and free cash flow. And then we have liquidity, which is where I just use the debt-to-equity ratio. And I like to see this under about a 2, and it's a 0.75, so that's good. Then we have the Rolex score. The Rolex score uses two things that I like to see, which is the Piotrowski F score, which is its own score in itself. Procter and Gamble has a 6 for an F score. I like to see it at a 7, 8, or 9, so it's close to the F score I like to see, so it gets a few points. And then the shares outstanding are decreasing, so it gets 5 points there. So next up, we're going to do the discounted cash flow. I do want to mention real quick that earnings are coming up, so the earnings call will be soon. And for Procter & Gamble, the earnings call is going to be on the July 29th, and its earnings per share as expected by the street is 1.23, and then revenues expected to be 19.41 billion. So we're going to see what happens. This will be in a couple days, so earnings aren't out yet, but you can see that Q3, Q2, Q1, and Q4 of last year pretty much beat earnings per share on all those different quarters. So, this company the past year has beaten earnings every quarter. Let's see what happens. Now let's go over the discounted cash flow. So for the discounted cash flow, I'm on GuruFocus.com. Now, this is actually going to be a very, very overvalued company based on discounted cash flow. So I have a fair value here of $84, essentially, let's say around. Now, I'm giving it a 7% growth rate in free cash flow. Now, over the past 10 years, 5.7% has been the growth rate. Over the past 5 years, 9.6%. So I'm going in between those two for the free cash flow growth. And I'm just not getting a very high free cash flow based discounted cash flow here. I'm getting a $84 price target. So that's it. So it's very overvalued in terms of this discounted cash flow, but let's throw it into a weighting, and then let's see what my actual target price is going to be. So this is what I got for the company. So 60% of my weighting is going to be based on the discounted cash flow because I do find that to be more important in terms of valuation. Then we have the EV to EBITDA valuation, just to throw in another kind of way of looking at this company. We're going to weight this 40%. So when we weight this, it's a weighted average of these two different methodologies. $82 price target and a $125. We're weighting them, and we get a $99 price target. So that's what I think this company's worth. That's where I'm comfortable purchasing this company to get the required rate of return that I want to get right now. So the upside is is negative, so negative 30%. So this company needs to come down from where it's currently trading for me to like this company. So that's what I have for my target price. Let's take a look at some technicals. So this is the chart for Procter and Gamble. So what do I see here? Well, let's talk about first how much the stock has gained over the past few years, going back to May of 2018. So this is a few years. We're going to look at how much the stock has gained, and it's gained about 123% over that time period. So you know what? You've gotten some decent capital appreciation with the stock. Of course, it pays a dividend too. So it's not a bad stock lately. Over the past 4 years or so, you've made a decent chunk of money by holding this stock. Now, it is definitely off the highs, so the stock got as high as about 163, traded all the way down to the 120 areas, and now it's sitting at about 144. So we have a little bit of an uptrend line here. We're going to draw this out. This goes back to June or May of 2020, and we can see we had a major touch here, and then it actually broke down through this line. So now we're zoomed in a bit, and as you can see, this stock broke down through this line, and it broke back up through the uptrend line. So what am I looking here? Well, I kind of see an inverted head and shoulders formation. That's what I'm looking at here. And so if this is an inverted head and shoulders, that's actually a bullish sign for investors. So if that is something you're looking into, if you're looking at this company, if you still like this company, even though I don't love the price of it based on the valuation I just did, maybe you do like how this company looks, and maybe you want to see maybe an entry point. So if you did, in this situation, you have about a 11% potential, let's say a growth if this thing does pan out. So we have a inverted head and shoulders, so you would draw the head to the shoulders, and then you'd project that up. That's how you usually do these things, which would put it about an 11% gain. So if that happens, if you were going to enter this position for the long term, could be a good time to do it. Or maybe you wanted to kind of swing trade this thing, whatever you're into. I'm more of a buy and hold investor. I just try to find entry points for companies I already like fundamentally. So that's how I invest. So I wouldn't be buying this stock necessarily, but I do think it's interesting time period for someone who may be bullish. And that is all I have for this video. So thanks for watching. Let me know if you like this company, if you have a different look at this company, if you're seeing it from a different lens than me. Let me know, and hit that like button, subscribe to future content like this, and watch another of my videos coming up right now.